Okay, welcome everybody. Today, Thursday, April 30th. So what I wanted to go over was, again, a typical exam style question, okay, related to this chapter. So we've looked at non-strategic investments, okay, which can be either holding shares of another company or a bond of another company. And then we also looked at an investment in an associate. So you got to remember, okay, if we own less than 20%, right, I guess it's like that, less than 20%, it's going to be non-strategic. Okay, anywhere between 20 and 50%, then it's going to be strategic. Okay, so I'd like you right now to go in your textbook, problem 15.5a. Okay. Okay, so 15.5a is a good question. The reason for that is because it gives us different transactions that were made throughout the year, okay, and we have to record those entries or record those transactions, but we also got to analyze the transaction too, okay, because it might be strategic, it might be non-strategic. So again, a non-strategic, I'm just looking around for another marker here. A non-strategic investment would be less than 20% ownership. Okay. Short-term ownership. Okay. Where strategic would be owning between 20% and 50%, okay? So again, when we're recording these journal entries, we've got to compare the information given to our rules of thumb here, okay? So let's go look at the first transaction. Well, let's read right from the top. Johnson Inc.'s non-strategic investment portfolio at December 31st, 2019 consisted of the following. Okay, 10,000 Xavier Corp common shares. Okay, the cost was $163,500. The fair value is $145. Now notice, it says the fair value adjustments were recorded on December 31st, 2019. So we don't have to look at our cost, okay, because we've already recorded the loss. Okay, so we're going to start with the fair value being, in the case of Xavier, $145,000 for 10,000 shares. Okay, same thing for Young, same thing for Zed. So let's look at the transaction here. We sold 750 common shares of Young for $36,000. Johnson Inc. planned to hold these shares for less than 1 year. Less than 1 year. Okay, so it's a non-strategic investment. Okay, so let's look at our first journal entry. Then on January 17th. Okay, so on January 17th, we received cash of $36,000. Okay, now we also have an investment, because we got to take some of our investments off the books. Okay, and the company's name is Johnson. Now, they sold common shares of Young for $36,000. Young, sorry. We're Johnson. We sold Young shares. Okay. Okay. So these Young shares, we had 1,250 Young common shares, now with a value on our books of $62,000. So what's the individual cost? So we'll take $62,000 divided by 1,250. So we're going to get an individual share price of $49.60 per share. Okay, so $49.60 per share, and we sold how many? Well, we sold, in this case here, 750 common shares. So $49.60 times 750. Okay, our cost is $37,200. as a result, we need to make this journal entry balance out. We must have had an investment loss, or loss on sale of shares, or loss on sale of investment, okay? Okay. This is a common journal entry, again, that you're going to see on the exam, accounting for a gain or a sale on the share sale of investments. Now, let's go to March 3rd. Okay, March 3rd, we purchased 5,000 common shares of Allen Corp for $300,000. Okay, so let's just stop right there. We purchased shares for $300,000. Okay, so we're gonna debit an account for $300,000, and we're gonna credit cash for $300,000. Cash is credited, obviously, because we paid that money. It went out. Now we got to say, okay, is this going to be a strategic investment or a non-strategic investment? Well, it does the work for us already. It says the shares represent a 30% ownership. Okay, so we're going to have investment in associate, debit our investment in associate Allen. Now remember, we always want to, when we're making these journal entries, we always want to signify who we invested money in. Okay, so who these shares are, Allen and Young, okay? And we also want to signify, is it an investment, so is it a non-strategic investment, okay? Or if it's a strategic investment, we have to say investment in associate. If it's non-strategic, you can just say investment, okay? And then the company's name, obviously. Okay, so we recorded a March 3rd transaction. Again, this is problem 15.5a. I've assigned problem 15.5b. It's very similar to this, okay? Now, on June 7th, we received dividends from Allen at a rate of $2.50 per share. Okay, so June 7th, okay, we received some cash. How much? Well, we own 5,000 shares, right? We know that from the March 3rd transaction. So 5,000, okay, I'll just put it here for now. 5,000 times 250, okay, how much is that going to be? $12,500. So they did send us the cash. Okay, so we're going to deposit that in our bank account. Now, remember, Allen is an investment in an associate. Okay, so when we have an investment in an associate, and that associate pays us cash as a dividend, it reduces our equity position. Okay, so it reduces our investment. So we'll go credit investment and associate Allen, 12,500. Okay. So again, that records the dividend payment that we received. If it would have been a strategic and non-strategic investment, we would have debited cash, credited investment income. Okay, but it was a strategic investment. As a result, we have to reduce our ownership or our equity position. Now, let's go to August 14th. We sold the remaining Young shares at $31.50. Okay. So in this case here, we started with Young shares of $12.50. Okay. Now we know the shares our cost was $49.50. Okay. We figured that out from the prior calculation on January 17th. So we have what, $12.50 minus $7.50. That's 500 shares to go, right? So in this case here, I'm just thinking about something. How many shares do we have left? That's not going to be right. So we're going to have to recalculate. We sold the remaining shares at $31.50. So $31.50, what date is that? August 14th. Okay, so August 14th, we received cash. Because obviously we sold the shares, right? So how much cash did we receive? $15,750. Well, how did we get that? Well, we had 500 shares left, okay, and we sold them for $31.50 a piece. Okay, which gave us $17.50. Okay, so that records the debit, or at least one of them. Now, what's the book value of these shares? Okay, well, we determined before that our cost was $49.50. So times 500, the remaining amount of shares is $24,750. Okay, so we're going to take the investment in Young. That's going to come off the books. Okay, so how are we going to do that? We're going to credit investment Young, $24,750. Okay, and then we have a investment loss. The investment loss account gets debited, okay, in the amount of $9,050 in order to balance out that journal entry. Okay, so that takes us up to August 14th. So you can take a look at what I've written down. Okay, also, again, I've sent you out the answer key, so you can always compare to the answer key. Now, November 28th, what happens? We purchased a 5% ownership in Davis by acquiring 10,000 common shares at a total cost of $89,000. We're going to sell these shares in 6 to 9 months. Okay, 5% ownership, so that's less than 20. We're going to hold it for a short-term period. It's non-strategic, okay? So I'm just going to erase a couple journal entry lines here. So in our case, November 28th. Okay, investment. And it was, what's the company name? Davis. For $89,000 and credit cash. Okay. Now, December 30th, we sold 10,000 shares of Xavier for $160. Okay, so December 30th. That is, we're going to receive cash of $160. Now, when we make a sale of an investment, there's almost always either going to be a gain or a loss. Okay? So again, we have to figure out how much are the Xavier shares on our books. Well, we own 10,000 shares with a value of $145. Okay, so let's go 10,000. 145 divided by 10,000 shares. That'll be how much? $14.50 a share, okay? So our cost is $14.50 a share. Okay. If we sold all our 10,000 shares for $160, okay, we must have had a gain. Okay, so we're going to take it off our books. Okay, investment Xavier. Okay, 145, and we had a gain on the sale of investments, or just call it investment income. Okay, for $15,000. Okay, now let's go to December 31st. Alan announces a net profit of $280 for the year. All right, well, one might say, well, okay, well, big deal. Alan, we have some ownership of Alan, but remember, it's a strategic investment. Okay, so since it's a strategic investment, what we need to do is we need to increase our equity position. Okay, so we own 30%, so we get to record 30% of that 280 as income. So 280 times 30%, okay, is $84,000. Okay, so December 31st comes along. Okay, we are going to increase our investment in associate. Okay, and that is Alan. $84,000, okay, and credit investment income. All right, so that completes all the journal entries. Okay, now let's just look at what do we have left? Xavier and Young, we don't have any shares of either of those companies. The only shares we have left are Zed's common shares. Okay, so normally what we would do is we would adjust Zed's common shares to fair market value. So at the beginning of the year, those Zed shares started at 35.6. We'd want to go and find a source that would tell us how much those shares are on an individual basis, multiply that by 120,000, and we would adjust upward or downward for our fair market value adjustment. Okay, so again, that pretty much wraps up all the types of scenarios that you would see regarding strategic and non-strategic investments. Now, the only thing that this question did not cover was purchasing a bond. Okay, so when you purchase a bond, it's always going to be non-strategic. Okay, you want to record the costs that you paid for the bond. Okay, so debit investment company ABC bond, credit cash, and then every year, every 6 months, you're going to get your interest payment. You're going to record your interest. Okay, and sometimes there's a fair market value adjustment on the bond, sometimes not. You would be given that information, and then when you either sell the bond or the term of the bond expires and you get your money back, you won't record a gain or loss if they give you back 100,000 and you bought 100,000. But if they're giving you more or less, then you have to make your adjustment for that. Okay, so that wraps up the review for today. Again, just remember, when you're analyzing each transaction, you got to figure out strategic or non-strategic, and look, is it less than 20% or between 20 and 50? We're not really going to see a scenario where it's over 50. That's kind of beyond our concepts right now. But what we do is we end up consolidating the financial statements. But again, that's more of an advanced topic. So that's it for today. If you have any questions, please let me know. Other than that, good luck, and we'll talk to you tomorrow.